Hello and welcome to Talking Stocks. I'm Gugulethu Cele. In studio with me, Ashton and Hechter, both from Anchor Capital. Now today we focus on investment opportunities in the wake of Brexit, which certainly very few of us saw coming. We thought that it was light at the end of the tunnel, but instead it was that oncoming train, right, Sean?
Absolutely. I mean, the polls were telling us something different, but the markets were saying very much leading up to the actual vote being announced, the results thereof, that it was a done deal that we'd stay in. And certainly the bookmakers' money was very much on the side of expecting things to remain. And as a result, it's been a shock, unexpected result, which I think if it ultimately plays out, that they do leave the EU, there's significant uncertainty between now and then in terms of the ultimate economic impact on the UK. It's clearly a negative. And what we've done in terms of our portfolios is we've gone and assessed which counters are affected by this particular decision, and whether or not share prices have under or overreacted to the news flow.
Mm-hmm. Let's pick up on some of those particular stocks. Capital & Counties, well-known property firm with significant exposure to the UK. Are we worried here about the changing dynamics for the firm?
Okay, so in terms of how we're looking at Capital & Counties now, we've stress tested the valuation to say that Covent Gardens was the key asset. As at the end of last year, it was valued at a 4.3% capitalization rate on the rental stream they achieve. That's the key income producing asset. The other assets that they own are largely developmental land in Earls Court area, and that's probably about 30 to 40% of the valuation of the company prior to this announcement or the Brexit outcome. And what we've said is, let's take Covent Garden and really stress test the valuation, push that cap rate up to 5.5%, which is a very high number for central London. And that would get you to, by the end of this year, on the basis of where we expect rental values to get to, that would result in a fair value of about £1.65 billion, which is down from £2 billion as at the last reported date, or £1.95 per share. What's more difficult to assess is the impact on the development assets, which clearly will be impacted. It might be harder for them to ultimately sell off the Earls Court land and develop the Earls Court land. And we've just taken a blanket 50% haircut to those values in a doomsday type of scenario. So we're trying to say,
50% is quite harsh.
It's quite harsh, absolutely it is, and we can't say with certainty whether that's too aggressive or too lenient right now. But we're saying let's just look at what could be aggressive in this environment, and that would take the combination of doing that with Covent Gardens at valuation, as well as the haircuts on the development assets, which are not income producing right now, would result in a sum of the parts valuation of about £2.50 a share. And at the current exchange rate, that's about 51 rands per share. So we're saying the share price got down. If you look at the lows, it came from £3.62 to a low of about £2.63, I think it was, trading at pretty much yesterday. It's bounced a bit today, but we're saying that at or around that £2.50 mark, which in rand terms is about 51 rand, we think that represents quite a hard floor in terms of valuation. That's a price at which a lot of fresh buyers should come in. So you've seen a very aggressive share price response. This business is underpinned by hard assets, and I think you don't want to be a seller at all costs, certainly. So the equivalent of 50 rand a share or £2.50 for us would represent reasonably compelling value. We acted quite swiftly for some of our mandates where it makes sense to do so from a tax efficiency point of view. So when you look at the Friday following the announcement, we were quite aggressive sellers in certain of our mandates of Capital & Counties, but at kind of £2.80 a share and below, we weren't really prepared to be letting go of shares at that level.
Let's touch on another company now, which is Brate. Again, we probably think about the exposure via New Look as one of the significant elements here which might be impacted. But what about rethinking the valuation multiples here, Liam?
So the way we look at Brate is to build the business up similar to Capco and Old Mutual and Investec on a sum of the parts basis. And Brate has operations in the UK. They own a clothing business, which is the majority of the current operations are in the UK. The future growth should come out of China in the form of New Look. But between New Look, the clothing business, Iceland Foods, the sort of discount retailer in the UK, and Virgin Active, about half their businesses in the UK as well. So Brate's got significant exposure to the UK market, and what we did was we stress tested a few of those multiples as well. We reduced some of the multiples for the New Look and Iceland Foods in line with sort of peer valuations, and that resulted in a sort of downside scenario share price of about 118 rand, and that's at least more than 10% lower than where the share is trading at today. So Brait is one where we still see possible downside. In fact, we were quite surprised to see it didn't bounce today with the rest of the market. So clearly there's a bit of method in sort of our thinking around the valuation multiples on Brait.
And I think it's important to make the point that management did revalue these assets in terms of the multiples they've applied to these companies, the underlying assets that they've owned as at September of last year. So they were using about 13.5 times EBITDA for New Look. If I remember correctly, about just shy of 9 times for Iceland Foods. And obviously the peer group has sold off quite dramatically following the Brexit outcome in terms of the referendum, to the extent that New Look's peer group, which will include companies like H&M and Next PLC in the UK. There's a number of other companies, but the average of that peer group, as they've used it, is now trading at circa 11.5 times EBITDA. So yeah, just applying that multiple results in the kind of metrics we're talking about. I think, to be clear, Brait is one company which we've backed for quite some time. We think they've got an unbelievably entrepreneurial management team that will continue to add value. So I would expect that over time the NAV would compound at a pretty decent clip of the next number of years. But this is one where you're saying, in terms of short-term action, what's happened to comparable assets on the market and how does their valuation in the very short term stack up? And I think on that basis we're saying there's probably a little bit of short-term downside. If you're picking an entry point, it may well be too early to be buying right now.
Sure. What about the banking environment? And maybe if we can touch on two companies, Old Mutual PLC, which we know is also going through a complete revamp at the moment. Perhaps bad timing to be selling off assets, and Investec, because they also have significant amount of exposure to the UK environment.
Yes, and I think, a few weeks ago we came on here very bullish on Investec, but clearly our base case scenario was that the UK remains inside the EU. So post the Brexit vote, I think Investec's life has fundamentally changed and has caused us to rethink the investment case on Investec. What we've done is to try and sort of flex out to see how much of the sort of future prospects of Investec have been impacted by the fact that they're not going to be inside the EU anymore. And at the moment we think that if you sort of adjust the valuations on the South African assets for the currency and then sort of adjust the wealth management and asset management assets to sort of reflect what, in a similar way to Brait, how peer multiples have changed, then it sort of leaves a scenario where the UK bank is down about 30% in pound terms in terms of the reflection in the market cap change of Investec. Whether or not this is justified, it's still difficult to tell. So Investec's one where we're still a little bit uncertain as to sort of where the downside is in Investec. We definitely think that the prospects in terms of the UK leaving the EU for the banking sector in general is not great. Banks are generally going to be the hardest hit, banks and possibly property companies. So where we see sort of downside on Investec, certainly the share price should have dropped, but how much of that drop is sort of reflected by fundamentals, we're still quite unsure.
And high street banks, I think the point to make is that many of the peer group have dropped by a similar quantum, where you might say that a bank of scale or a bank that's lacking scale, which we would regard Investec's UK operations do not have the same scale as that of a Barclays, for example. It might be quite hard for them to sustain the return on equity profile that they've been able to achieve up until fairly recently. And if you look back to the most recent reported numbers, they were making a pre-tax RE of about 14%, so you've got to take off a bit of tax there. Yeah, but there's every possibility that their profitability in the UK could be impacted to the extent that they start making a sub-economic return on capital. In other words, the return on equity may dip below their cost of equity, which would argue for a discount to book value. And that's certainly what the share price is beginning to reflect anyway.
So at the moment, the UK bank's probably trading at about a 30% discount to its current book value. So that's sort of already pricing in that the bank isn't going to be able to generate a return on equity above its cost of equity. Sure. We do think that that's a likely scenario. So it's not clear that Investec's offering value at the sort of 90 Rand level. If my gut feel would be that it sticks between 85 and 95 Rand a share while this sort of uncertainty over Brexit sort of hangs over it. Probably be range bound, and the other businesses are impacted, but I guess it's already reflected in the price. Yeah.
What about Old Mutual as well? Currently in the process of spinning off some of its assets and establishing Old Mutual emerging markets. What have the knocks been here as we take a look at the valuation?
So I think the metrics that the way that we've looked at it is to say, obviously the parts that make up the value for Old Mutual, it's also some of the parts type of equation, of which Nedbank is one of those. And we've taken a haircut to Nedbank's valuation in line with the market cap movement that bank has experienced over this time period. So that's about 7% movement. At the same time, Old Mutual emerging markets, we've taken about an 8% movement, 8% haircut pre-currency movements, and now we know that the rand has obviously strengthened against the pound over this time period. So you've got to kind of add that back. So there's a few moving parts, but to get to the share price that you have today, taking into account the adjustment that we've taken on Nedbank, the Old Mutual Wealth business implied valuation has dropped about 30% or so. And now that places that business in a position where you're trading at a kind of sub 10 times forward P multiple for Old Mutual Wealth, which is their UK wealth manager. And that's a business that could well continue to deliver fairly reasonable growth. So we think this is probably one example where Old Mutual where the share price has gone too far.
Yeah.
I would argue that Old Mutual might be looking relatively cheap.
As we do close off with very briefly though on all these major counters that we've touched on, Cap & Co, Braid together with Investec and Old Mutual, buy, hold or sell? And again, I'm sure things continue to change on a day-to-day basis, so it makes it even more difficult to call, right?
It's very hard to call right now because the share price movements are so sharp. And as we're speaking today, Capital & Counties, I think, is about 6% off its lows of yesterday. I think what we're saying is pick your entry points. So the fundamentals have changed for something like Capco, but there's very definitely, we think, a flaw to the valuation because it's hard assets that you're buying, which have a value. And at something like 50 Rand a share, in terms of the equivalent Rand value, we'd be quite happy to pick some shares up. That's about £2.50 per share. In the case of Braid, we think it's too early. So in the short term anyway, we back the stock longer term. In fact, we back the company longer term. We think they've got a great team. But we think it's probably too early to be bottom picking there despite the share price retracement that you've seen. Exactly. Investec, I agree with Liam. I think it's likely to be range bound from here. We need to assess that. And out of all the companies that we're talking about here, their lives in terms of the operations that they have in the UK, specifically the bank, have probably been the most impacted. And then Old Mutual, I think we would probably be calling that a buy right now. It looks like pretty good value, getting about a 4-7% dividend yield, which looks reasonably attractive to us.
Well, we'll leave it there for today, but interesting landscape that we're currently dealing with, and one again which is characterized by uncertainty and volatility, two things that investors don't usually like. But a big thank you once more to both my guests, Sean Ashton and Liam Hechter, both from Anchor Capital. Join us next time though, where we talk more stocks.